what it says. Check this one. What we have done yesterday, a quick revision about that. We have done something related to what is the financial asset, financial instrument, financial asset and financial liability. And we have covered about the equity instrument. Okay. What is the first financial instrument, financial asset, financial liability and equity instrument. Okay. Now they are given you three different scenarios. They are asking us, IS 2032 provides rules of classification. The issuer of financial must classify whether it is a financial liability or it is an equity instrument. At the beginning, okay, at the beginning only you have to identify whether it is a liability or investment according to the substance. Okay, what is the reality? Okay, substance over form means whether you own or you don't own, you have to pay your borrowed money, what is the conditions, whether it is for a fixed term, whether it is for a indefinite term, what is your intention, everything is to be clear. Is it right? They gave you three different scenarios. Okay, read one by one, make it very clearly. Coaster wishes to purchase a new ride in Animation Galaxy theme park but requires extra funding. They need some more amount. On 30th September, they have the following preference shares. Now you see the thing, 1 million preference shares. How much is there? 1 million preference shares. Okay, 1 million preference shares. What is the value? 3 each. No dividends. Okay, no dividends. Okay, are payable. They are going to redeem it. Is it right? They have going to repay it. Okay, repay it in years time. What they will do? They are going to redeem it by issuing what? By issuing the equity shares. Means they will replace the preference shares with the equity share. The exact number of ordinary shares issuing how much? They are issuing 1 million into 3. Okay, 1 million times 3, it comes to 3 million. They are going to redeem it with the same amount. Okay, with the same amount. They are redeeming, they will repay with the same amount. Now they are going to, is it right? The exact amount of ordinary shares will be based on their fair value. Is that what is the exact? The amount will be based on the fair value. If there is based on the fair value, either it will be go up or it will be go down. Either it will be go up or it will be go down. Based on that, what they are asking you discuss whether these financial statement, whether it is a financial liability or it is a equity. Now you have to mention whether it is a equity, is it right? It is going to be at the beginning, initially, or it is a financial liability. What is the concept of equity? Again, when very simple, I have to go. What equity says? Any contract that evidence.
Financial liability.
Huh?
It will be financial liability.
It will be. Why?
Financial liability.
Why?
Because there is something non-derivative contract which the entity may obligate to deliver the number of equity on equity instruments.
Okay.
So they are taking funding and they are paying by preference share.
Yeah. And anything else? Anything else?
Doctor, because I didn't say equity because in the rules of the equity it shows that they have to only pay the different amount of interest only.
Yes. Okay, see the thing. Is that what they say? They are issuing the preference shares. Is it that they are issuing the fair value? Okay, fair value. If they see the rule, what we have done in the when we calculated whether it is a sale or it is a lease. Okay, when they are saying that we are going to take 3 million and we will repay it. Okay, we will redeem it. Is it right? Redeem the exact number of shares issuable. Exact number of ordinary shares issuable will be based on what? It will be based on the fair value. If it is based on the fair value, definitely the fair means there is a promise. There is a promise to redeem. Okay, after 3 years. It is not an indefinite period. It is not an indefinite period. If we are talking about the indefinite period, it is going to be equity. If you are talking in terms of the residual interest, it will be equity. It is that there is a contract that it is going to be repaid after 3 years based on the fair value. When we say the one thing that matters is they are going to be redeemed, is that they are going to be repay it after 3 years. If they are going to repay it after 3 years, it means it is a liability. Are you clear about this?
Yes.
Next. Okay, next. What about this second point? Tell me. No dividends. They are going to be redeemed.
Liability.
Redeemed in 2 years' time. They are saying it is going to be redeemed 2 year time with 3 million ordinary shares replaced. Is it they are taking away 3 million ordinary shares. Okay, 3 million ordinary shares fixed. Okay, they say that it will be issued. They were issuing. They are issuing. See, initially till 2 years. Okay, initially two years. It is not a. We cannot say that they are how much they are saying. They are taking into how much 2.8. Okay, 2.8 2 million ordinary shares. Is it 2 million? Sorry, 2 million preference shares. 2.8. And they will redeem it by issuing an ordinary shares. See what is the difference? Again, I will go back. This is the basic difference. Okay, they say that they say that if it is going to be the evidence a residual interest in assets after deducting fine. Okay, that is not going to give us a contractual obligation to deliver cash. Is it? Are they delivering cash here?
No.
No. If they are not delivering cash, it is not a liability. A contractual agreement to exchange financial instruments with another in potentially unfavorable terms. What is happening? They are not exchanging instruments. Okay, they are potentially. It is unfavorable. No, they are taking. See the thing. 2 million is there. 2 million at the rate of how much? At the rate of 2.8. Okay, 2.8. It comes to how much? It comes to almost 5.6 million. They are going to issue how many shares? Fixed number of shares. Is it fixed number of shares at the rate of how much? At the rate at 3 million ordinary shares. 3 million ordinary shares. Here they have not. We don't have any clear cut thing that it is unfavorable, because 5.6 is more. 3 million is there. We should know what is the fair value. Is it? What is the fair value? Coming back to this point. Okay, fact the thing. They are issuing 2 million preference shares, 250 each. We are not going to pay any dividends. We are not going to pay any dividend. No dividends are paid. In equity shares also, there is a condition. There is no condition that you have to pay dividends. Nowadays, very few companies will pay dividends. Automatically, what is happening? If they are not paying dividends, the market value will increase. Is that the market value is increasing? Okay, the preference shares will be redeemed in 2 years' time. They are issuing, means after 2 years, it is going to be identified as what? It is going to be identified as an equity shares. Now, in the beginning, we have to treat this as a equity, or we have to treat it as a liability.
Liability.
How they are treating is as liability? In the
1 minute, doctor, 1 minute. If we take 2 million, it will be 5.6, and they are paying later 3 million. So but there is a difference of 2.6. The 2.6, it will be an equity as per the definition upside. The difference between the interest which is being left.
Fine, that's okay. That's okay. If it is treated as equity, you will have the share capital, you will have the share premium. That's fine. I'm not arguing on that. We are not doing that. We should know that after 2 years, it will be in the previous case. What is they will exact number of shares issuable will be based on. Is it based on the fair value? Okay, here they say the fair means what if the fair value is more or fair value is less, we are going to calculate based on the fair value. There is no condition that you are going to issue. Here the difference is, here it is a variable in nature. Here it is variable in nature. Here it is fixed in nature. And they say, is it right? They say that it will be issuing. Okay, it will be issuing. Here it will be issuable. Shares are issuable. See the thing. This word makes lot of difference. Shares are issuable. Here they are issuing. Khalas. Means at the end of 3 years, they will issue. At the end of 2 years, they will issue. If at the end of 2 years they will issue, means they are, there it is not a liability, it is a
Okay.
is it okay?
Yes.
No, I will not tell you this. Come your judgment.
Doctor, this is equity, direct.
Is it okay?
A dividend payable.
Are you clear about this?
They will pay by dividend, they will not pay by cash.
Yes. Is it okay?
Yes.
Now, the accounting treatment of interest, dividends, losses, and gains relating to instrument should follow the treatment of the instrument itself. Dividend paid in respect of preference shares classified as a liability will be charged as an interest. Government point, if the preference shares are liability, is it right? It is similar to loan. I'm not saying that. It is similar to loan, then we have to treat it as an expense. Dividend paid on shares classified as a equity will be shown in the statement of changes in equity. Is it very straightforward? If it is a liability, it is a interest expense. If it is a equity, we have to show it in the statement of changes in equity. Are you clear about this? Is it okay?
Yes.
Next.
Okay.
Offsetting. What is it? Offsetting. Offsetting is we have done somewhere where we have done in chapter 1 or chapter 2, chapter 1 or chapter 2.
IFRS 18.
IS 32 stated may only be offset in very limited circumstances. We cannot say that there is an asset is there is a liability there. We have to show asset as a separate value, we have to show as a liability as a separate value. We cannot, because both are having different characteristics. Okay, both are having different. You have made the investment 5 million. Okay, you have made the investment 5 million. Now you have taken the loan to make the same investment. You have taken the loan at the rate of 5%. You cannot say that I will show you a net amount of 2 million. It is wrong. It is wrong. It is only this is the point. We can do it in very limited circumstances. It cannot be done in all the time. Is it? Why? What are the limited circumstances? It can be legally enforceable right. Very few cases in business combinations, payables, receivables, purchases, and sales. Is it? Payables, receivables will be offset in business combination. sales receivables. It's a intends either to settle on the net basis or to realize the asset and settle the liabilities simultaneously. Only in these two conditions, is it right? It is legally, if it is fine, it is permissible, legally enforceable, we can do it. Or it will be on the net basis. Fine, both, if you, I told you, receivables and payables, we can offset. Sales and purchase between two entities, we can offset only on business combination. Otherwise, it is not permissible. We cannot offset. That is why they say it is a very limited circumstances. Okay, very limited circumstances. The classification of an instrument is a liability or a equity will have a major impact. Leverage will change, debt equity ratio will change, okay, return on equity will change. Is it all the ratios will have impact, okay, thus affecting investor perception of financial performance. Is that what will happen if you put the debt as an equity, or you can put equity as a debt? What is happen? Your return on equity will change, okay, your return on capital employed will change, okay, is that return on capital, your EPS will change. So many ratios will get affected. Wherever there is a equity is there, all the things will get affected. So we should be very clear. That is the reason whether it is a liability. That is why we will give importance to identify whether it is a liability or whether it is a equity. If the entity issue an instrument and you are going to classify it as a liability, then see what will happen. See that the gearing will rise, entity will appear more risky, the servicing of the finance will be charged to profit and loss account, it will reduce the profits, and it will also have impact on the earning per share. A small mistake if you are doing classification, it will have multiple effects. It will have multiple effects. It will be because, is it right? It will have, if the entity issues an instrument and classify it as an equity, then gearing will decrease. Debt, is it a debt and equity? The servicing of finance will be charged directly to retained earnings. Statement of changes in equity, dividend paid. So it will impact on profit and earning per share. If we are talking about the equity, automatically number of equity shares will increase. The moment number of equity shares will increase, automatically everything will have impact. Number of equity shares are decreasing. I will write here. N is nothing but number of equity shares. Number of equity shares are increasing or decreasing. It will have impact on all other things as such. In order to ensure instrument is that is the reason we have to faithfully represent it. In the fund, the directors will need to apply the principles of what? The principles of IAS 32, presentation of financial statements. That is the reason this is so important. Whether if it is a liability, it should be a liability. If it is a equity, it should be equity. Any is mismanagement, anything miscalculation, anything misrepresentation will always make it a point that the entire evaluation will change. Is it okay?
Yes.
Okay? Now, recognition. Okay, recognition of now we are very much clear. Only first we talk about liabilities, then we talk about the equity, then we talk about the investment. Everything separately is there. Convertible bonds, we talk about the thing. Okay? At initial recognition, okay, at initial recognition of any financial liability, it should be measured at fair value. That's all. It should be measured at fair value. If the financial liability will be held at fair value, means what is the actual value as on the date of issue. If the financial liability is fair value through profit and loss account, what you have to do, transaction cost should be expensed to the statement of profit or loss. If you are held the liability at the fair value. Definitely, fair value means it will change every year. It will change at the every reporting year. We are taking very simple message. It is on the year basis. We are evaluating on year basis. If we are talking on year basis, we have to take fair value through profit and loss account.
Doctor, what is below the transaction cost?
Transaction cost means issue cost. Issue cost. Is it a transaction cost? Is
only issue cost? If there is any delay cost?
There is
like
any?
Interest on delay, something?
No, no.
Delay?
No. Transaction cost is issue cost, brokerage cost. Okay, brokerage cost, issue cost. Okay, transaction cost. We have to expense to profit and loss. These expenses is going to be classified as a financing unless the liability is a derivative. If it is a derivative, we will see the treatment will be different. Otherwise, if it is a normal financial liability, then you have to treat it in the as a based on the fair value. You have to treat it on the financing section. Now, there are two options are there. If the financial liability will not be held at fair value, is it? Means then transaction short should be deducted from its carrying amount. Is it right? See the thing. If it is for a short, I am giving it more clearly. If it is for a short term, okay, it is for a short term. Is that fair value? Then what you have to do? You have to expense it. Expense to profit and loss. If it is not for a short term, it is not held at favor of profit. Means if the instrument, is it right? If the liability, okay, if the liability is how much? Liability is 1,000. Then whatever the transaction cost, okay, whatever the transaction cost should be deducted. Assume the transaction cost is 10. Okay, how much you have to show? You have to show it as a 990.
This is only if the transaction cost is or the liabilities is not too much here.
Not at fair value. If it is at fair value, is it right? If it is at the fair value, we have to expense it. If it is not held at the fair value, we have to deduct it.
But I didn't understand.
See whether you are.
No, I didn't understand the fair value. How they are evaluating at fair value?
No.
What is meaning here by fair value?
Now you see the what what is there? You are saying that you have issued the bonds. Okay, you have issued the bond. Then you are issuing the bonds, and then you will say, I am going to measure it. Okay, I am going to measure it based on the fair value. Is it? I am going to measure
current value, yeah?
Yes, exactly. Yes, at the current value. Okay. Now, when you are issuing at the current fair value, what is the? If you are doing at the fair value, what we have to do? Whatever the expenses, transaction cost, whatever the transaction cost, that transaction cost should be expense. Are you clear about this?
Okay.
Means if you are issuing at 1,000, okay, if the fair value is 1,000, we are saying that whatever the transaction cost, we will not deduct. 1,000 will show at a 1,000, and it will change. Fair value will always change every year. Okay, if that is the case, whatever the expense is there, we will going to show it in the profit and loss account. If it is not at fair value, is it right? If it is not at fair value, we will deduct, and directly how much we are going to show, we will show it as a 990. If you are not sure, if it is not held at fair value, Is it right? It will not miss major. Is it? You see, when you are going to, what is the fair value concept? Fair value concept is nothing but the value of the financial liability will change as per the current value of the instrument. Okay, we have to be very clear. We cannot change when the time of issue, we have to make it very clear that are we going to be valuing at fair value or we are not going to value at fair value. Whether it is at fair value or not, very simple. If it is at fair value, whatever the transaction cost, we have to expense it. And whatever, see, fair value will be 1000, next year fair value will be 900. Fair value will change. Okay, fair value will change. First year it will 1000, then it will be 1100, then it will be 1050. Is it right? Automatically what will happen? This is fair value gain and losses. Is it? You have to differentiating. You are separating. Very simple. You are separating the fair value and the transaction cost. If you are not held at the fair value, in other terms, it is not like that. Assume it you are going to held at the cost. If you are going to held at the cost, you have to deduct the transaction cost from that amount and we have to show the net amount.
Got it.
Okay?
Yeah.
IFRS subsequent measurements at the end of the year, at the end of each year, that there are two potential approaches for subsequent treatment. There are two approaches are there. Either you take amortized cost or to take fair value through profit and loss. What is the amortized cost? Amortized, see, it is a liability. Okay, it is a liability. Either you take a bond or you take a loan. How much is there? You have taken 1000. Okay, you have taken 1000. What will happen every year? Okay, you are repaying 200. Is it that means how much is the balance? 800. The second year, you are paying 200. What is the balance? 600. Like that. Amortized cost means it will decrease from year to year. But the end of year 5, it will be 0. It will be 0. Okay. Now, are you clear about that? If it is, there are two approaches. We can do it either amortized cost, we do it at a profit and loss. Note, what they are saying, the fair value through profit loss categories is usually only in some specific circumstances. Most of the financial liabilities will be measured at amortized cost. They made it very clearly. Means the most of the time we are using which type of cost? Amortized cost. Is it okay?
But I need only one clarification.
Tell me.
The initial recognition of financial liability, this is at the time of
Issue.
acquiring the loan, yeah?
Yes.
At the time of acquiring a loan or bond or whatever. And at the end of the year, we are doing subsequent measurement for the total liability that we have, yeah?
Yes.
Okay.
Initially, you take example, you have taken the loan, okay? And at the end of the year, definitely you pay back the loan. That amount will be deducted.
Okay, I got it.
Okay. Now, most financial liabilities such as borrowings are measured at amortized cost using the effective rate of. There are two interest rates will be there. One is the coupon rate and one is the effective rate. Effective rate is the current rate. Okay, current rate. Okay, effective rate is that the effective rate of interest is considered more in detail below. Effective rate is what is the current rate. See, you are saying that. You will say what they say. You will say 6% loan. Okay, 6% loan. How much is that? 10 million. This is the interest. You are going to pay interest on this. Is it? Plus you are going to say that effective rate will be more or less, okay? Effective rate will be no. Effective rate will be, they say that effective rate method is, they say that it is going to be 8%. Means actually you have to take 8%. But what is the agreement is there with us? The agreement is there for 6%. And continuously we will pay as per the agreement. Okay, this is where we will have the advantage, whether it is a profit or it is loss. It is a gain or it is a loss. Okay, effect means when we are talking, it is there in the financial liability, it will be there in the financial asset also. We have done, if you take into consideration, we have done with respect to lease payments, but we are not done in that much detail. In the similar pattern, we continue that. In the similar pattern, not the same one, it's something more or less similar. Now, assume that the company take out a 110 million bank loan for 5 years. How much they are paying interest? They have to pay 10% interest. The interest payable will be how much? 1 million. The total cost of the loan is how much? The total cost, every year how much they are paying? 1 million interest for 5 years. The interest cost is going to be how much? 5 million. Now assume that they have issued the bonds. The bonds has a nominal value of 10 million. They have issued the bonds. Okay. Now this is different. This is different. And interest payable is how much? 10% in arrears. However, the company issued the bonds for only how much? 9 million and agreed to pay 12 million in the bonds in 5 years' time. Is that how much they have seen? What is they say? They say that the value is how much? 10 million. Okay, now how much they are collecting? They are collecting 9 million. But they are saying that after 5 years, how much they are paying? They are paying 12 million. We have done, if you remember, sale and lease. Is it right? Sale and lease. This amount is less. This amount is more. Okay, how much is the difference? The difference is how much? The difference is 3 million. This 3 million is nothing but the interest payment. Are you clear about this?
Yes.
Okay, 9 million. Yes. They are paying how much? They are paying 1 million. Okay. Now the only 9 million agreed to repay. Interest is how much will be paid each year. Okay, interest will be paid each year. Total interest payment is how much? 5 million. Okay, now apart from that, that entity must pay back 3 million more. Okay, the 3 million more. What is the cost of the loan? Cost of the loan is 5 million is the interest, 3 million is nothing but the additional amount, difference. How much you are taking? How much? You are taking 9 million. Okay, you are taking 9 million and you are going to pay how much? 5 million plus 3 million. In accordance with the accrual concept, the cost should be spread over 5 years. As it happens, okay, as it happens. This, what is the effective? They want to tell you what is the concept of effective rate. This is achieved by charging interest on the liability with the effective rate of interest. What is the effect? See how much you are going to take. You are going to pay 5 million as a interest. Is it right? 5 plus you are paying how much? 3 million. Is it? This is what the actual amount you are paying more. Then in that case, on this basis, they will calculate what? They will calculate the effective rate of interest. In examination, this is all done previously. In examination, they will give us effective rate. Is it? They will give us as well as they will give you a interest. Interest is the amount we are paying. It is interest is the amount we will pay. Whereas effective interest we calculate on the opening balance, how it is going to have impact with overall rate of interest. The effective rate will spread, definitely will spread over the period of 5-year life. The effective rate is nothing but the internal rate of return. Any idea about this? IRR?
Yes, internal rate of return.
Internal rate of return. Where what is there? Where the borrowing rate, okay? Where the borrowing rate and where the repayable rate. Where the borrowing and the repayment rate will be same. Neither it will be positive NPV, it will be not be. Means what is happening if you are talking about the effective rate of interest, whatever the amount of borrowing we will take and whatever the effective rate, the rate that exists in the market, if you balance it, if you equate it, it will at the end of the day there will be no profit, there will be no loss on the issue of liability.
But still they are paying more, yeah?
Still they are paying more, okay? Still they are paying more. Is that they are paying more in terms of nominal values, okay? They are paying in terms of, we will cover this, okay? We will cover this, okay? We will cover this. See that this is the what it says. We are going to take the opening liability plus we will calculate the effective rate, we will minus the nominal value and we will get the closing balance. Effective rate is what is the actual rate that prevails in the market as of today. Okay, as of today, what is the effective rate? That effective rate will be considered for our...
Well, it is as of today or at the time of issuing?
At the time of issuing, that is a nominal rate, coupon. At the time, this is at the time of issuing.
Okay.
Very clear. There should not be any doubt here. Coupon rate is at the time of what is there on the what is the agreed terms of at what rate you will pay the rate of interest. 6% loan, 7% loan, 10% investment. This is the coupon rate. Effective rate will be maybe if you have done yield. What we are getting right now that exists in the market.
Like we can say market rate here.
Yes, in some cases I think in some cases they mention the market rate also. Okay? Now, the initial carrying amount of financial is that if the initial carrying amount of financial liability measured at the amortized cost is as you pay the value will decrease. Is the fair value less any transaction cost? Is that a fair value less if it is going to be measured at the amortized cost? An interest expense is charged to the liability. See that an interest expense is charged to the liability using which rate? Effective rate of interest. The interest rate will increase the carrying amount of the liability. See if you are taking the rate of interest. What is the current rate? Current rate is going to be more, plus or minus. There is no condition. We will say that as per the effective rate, the liability value will increase. The value of the liability will increase. But what will happen? We are paying interest. We are paying interest at the coupon rate. The coupon rate. Where we are paying interest at the coupon rate, automatically we are calculating at the effective rate, but we'll pay at the coupon rate. At the coupon rate. When we are talking about the effective rate, what is happening? The interest expenses will increase. The interest expenses will increase because current rate, what is the effective rate as of today? But agreed rate, when you have taken loan 2 years back, when you have taken loan 1 year back, the agreed rate will be less. Okay, usually the rate of interest will fluctuate, and every time we have to consider the rate of interest which is ineffective in nature. Is it okay?
Yes.
Little bit, okay, little bit. Just wait for a while. The moment you go further, you will have more clarity. This is the normal one, okay? When you are talking about the effective rate, interest expenses, financing section, your liability will increase. Because of what? Because of the effective rate. Next, the liability will be reduced by when you are making a cash payments. Is that when you are making a cash payments, what will happen? The liability will decrease, okay? When you are repaying, the liability will decrease. Desiree, we have to write general entries. When the interest is paid, interest expenses debit and liability will be credit. When you are paying the cash payments, repayments, or in terms of interest or in terms of any loans, debit will be the liability, credit will be the cash. In exam, assume interest is paid in arrears. Is that most of the time? In the exam, assuming interest is paid in arrears, you might find the following working useful. You will take the opening liability, you will add, they will give you effective rate of interest. On the opening balance, you have to calculate effective rate of interest. They will say what is the cash payments and what is the closing liability. The interest expenses is typically charged to the financing section. That's okay. It is a financing factor. The cash payment will be part of interest paid. In where we are going to show in the statement of cash flow as a cash outflow. The closing liability will be shown in the statement of profit and financial position. Here they are covering all three financial statements. The interest expenses will be in the statement of profit and loss. Okay, the cash payment, is it right, will be part of interest paid in the cash flow statement. If you take the cash flow statement, you have the interest paid will be in the operating section and the repayment of the loan will be in the financing activities. Is it in the operating activities and the financing activities? Is that whereas the closing liability, we are showing it as in the liability. We are going to show in the most of the cases, we will show in the as a non-current liability. Is that if you are dividing this, when you are doing the classification, what is the amount of non-current liability and what is the amount of current liability? If they ask you classification, we have to distribute in the closing balance into two different ones. How much? What is the amount of non-current liabilities and what is the amount of current liabilities? Is it okay?
Yes.
Now you see the things. Now you will have the illustration is there. Loans issue at discount. James issued a loan note. How much? 50,000. The loan was issued at a discount of 16% of nominal value. Okay, if they say 16% of nominal value, 50,000 into 16%. Is it clear about this? Is it how much they are discounting? They are issuing at what? If you take 16, they are issuing at what? They are issuing at 42,000. The issue cost is how much? 2,000. How much is the issue cost? 2,000. What is the initial recognition? Initial recognition is 40,000. Is it clear to you?
Yes.
Okay, now. Okay, initial is 40,000. See the thing. Oh, this is the initial recognition. Year 1, we take 40,000. On 40,000, we will add interest at the rate of 12%. It comes to how much? 4,800. Are you clear about this? Column number 1, column
As
number...
per the amortization cost, yeah?
Huh?
As per the amortized cost.
As per the amortized cost. Okay? Okay, 4,800. how much you are going to pay, how much there is a cash payment, we will see the effective rate will be calculated, write down some way. Is it at the effective rate? Okay, the effective rate. It will not change. The effective rate will be calculated. Okay, the effective rate will be calculated on the initial balance. Okay, whereas the cash payment will be calculated on the nominal value. Here they have mentioned some way. Here they have mentioned nominal value. Keep it in mind. I am putting it in a way. Is it? This is interest expenses will calculate on the opening liability, whereas cash payments will be calculated on the nominal value. Is it okay?
Yes.
Okay, very clear. There is no point of doubt. Okay, this is they have mentioned what is the nominal value. Nominal value is 50,000. Is it nominal? Initial liability we will calculate. Initial liability. Initial liability is nothing but it is based on the net proceeds. Net proceeds is nothing but the discount and issue cost. Is that net proceeds are not? On effective rate will be calculated on the opening balance. Okay, 40,000 into 2. Whereas cash payments will be calculated on the nominal value. 1 plus 2 plus 3 plus 4. Column 5 equal to 2 plus 3 minus 4. Are you clear about this?
Yes, Doctor, I have one point.
Tell me.
See the cash payment at the end of this solution, it shows the statement of cash flow. So the statement of cash flow is not the statement that we are taking the elements from statement of financial position and P&L.
See, how much is we are going to show in the statement of cash flow? We are going to show statement of cash flow is how much? 12,500. Whatever the interest expenses we are paying. Okay, what are the interest? How much is the interest expenses in the financing section? We are going to show in the financing section the effective rate of interest. See now the three things are very different. In the statement of cash flow, we are going to show how much we are paying cash. That is the reason. Here they mention very clearly. What they have mentioned very clearly, this is the cash payments. If there is a cash payment, means there is a cash outflow. Are you clear about this? Cash outflow in operating activities in the form of interest expenses. Okay? Are you clear about this? The same process will continue. Opening balance plus effective rate of interest minus interest payment, closing balance. Now you see the thing. By the end of the year, how much is there? They have mentioned somewhere. Is they say that at the end of the year, is it right? At the end of the year, they are going to pay how much? They are going to pay with premium 4611. Is that there is going to be a premium of how much? 4611. Effective rate is right. When they say 4611, it constitutes of what? The nominal value. Okay? The nominal value is how much? The nominal value is 50,000 plus. What is the premium is there? The premium is there 4611. If they it will come to 54611. Means they are repaying the amount with premium. They are issuing at discount. Okay, they are issuing at what they say that they are issuing at the discount, but they are repaying at a premium. This is where we say at the end of the day it will be there. This is where the concept of IRR will come into picture. Is it okay?
So, doctor, for cross check, we can use this one, yeah?
Yes. Here we are doing for 5 years. In the examination, if they ask, they will only ask for 1 year. Very rare circumstances they will ask for maximum. Only thing is, if they are asking for 1 year, you have to mention what is the non-current liability and what is the current liability. Is it clear to you?
Yes.
Next. See the thing. That's what it says. Is that they are talking about the 50,000 capital premium. They are talking about the interest. Okay, they are talking about the interest. How much they received cash? They received cash only 40,000. Okay, they are paying more. Okay, they received less. They are paying more. Total interest expenses.
Doctor, we need to write this. Can we just mention the table in the table once in the exam?
We will do this. I will show you what we are going to do. Okay, we will do the question answers are there in the in next. We are going to solve those things. Okay, this is the same process. In the same process, I told you, don't get panicked that we are having 5 years. Nobody, time management is very difficult. The only thing is, it is not the subject, it is the time management. You have to focus on time management. And they will give you, definitely, there will be always be a shortage of time. The only thing is, if you are managing the time and doing the questions or attempting all the questions, there is a, inshallah, probability is that you will pass. You have to attempt all the questions. That is only one challenge we are having. We don't have challenge with respect to the subject. Subject, there is no problem at all. I am confident my students will do. My only that time management is not in my hands. It is there in your hands. Is it okay?
Yes.
Now, they are given all the thing. We will do this. See the thing. Now you see the thing. Here it is there. Okay? Here it is there. Now, what they are saying, is it right? I will putting the numbers. Okay? I will put the numbers. This is a very lengthy question. Okay? It is a very, but even we cannot ignore. What is that? They say effective rate is how much? Effective rate is 7%. Reporting date is 32%. They have the issue cost is there. Issue cost can be ignored. Is that they are saying it is going to be on premium. Come from beginning. Hoy raised finance by the issue of 2-year bond, nominal value of 10,000. It was issued at discount of how much? 5%. And they are going to repay at a premium of 1075. Issue cost is ignored. Nothing is there. The bond has a, what is the effective rate of interest? Effective rate of interest is 10%. This is one question, one scenario. The second one, this is with respect to Hoy. All three are different. This is with respect to Hoy. This is with respect to Wiggins. This is with respect to Cavendish. Is right? Now, they have raised finance, issue of 2-year bond. Means if you take the example, okay, this is the point number 1, okay. Now, is it right? Hoy, it is a financial asset. It is a Hoy has the financial liability. Is that he has to pay financial liability. When it is a financial liability, it has to be amortized. Is that it has to be amortized, okay? It has to be amortized, okay, over a period of time. Okay, it has to be amortized. Now, what is the initially? It is a initially measured. Is it right? Initially measured at fair value. Is it initially measured fair value? What we have to take? We have to take net proceeds. Is it net proceeds? Okay. Now what will happen every year? Each year. Okay. Each year the liability will increase. Is it? The liability will increase. The liability will increase with what? with effective rate of interest. Is it? And reduced by what? And it will be reduced by what? It will be reduced by cash payments. Is it? That is. Now, what we have to do? We have to know what is the net proceeds. Okay, net. Why we have to calculate net proceeds? We have to calculate net proceeds. Okay, how much is the nominal value? Nominal value is how much? Nominal value is 10,000. Okay, nominal value is how much? 10,000. They are giving you discount. How much is the discount? The discount is 5%. Means the discount is 500. Are you clear about this?
Yes.
Okay, that is there. Okay, means discount. There is no issue cost is there. Means how much they are getting? They are getting the 9,500. Is it? This is the initial recognition. Is it right? This is the initial recognition. Is it initial recognition? What is the value? 10,000. 10,000 is the nominal value. Keep it in mind. Is it? 10,000 is the nominal value. Okay, effective rate of interest is 10%. What is the coupon rate? 2%. Means we are paying the cash payments at the rate of 2%. We calculate effective rate at the rate of 10%. Okay, we calculate at effective. Now what we have to do? We have to take the table. Here you have to take the opening balance. Okay, we have to take the effective rate of interest. Effective rate. Okay, we have to make the cash payments. Is it cash payments? We have to take the closing balance. Cash payments will be done on what? Cash payments will be done on nominal value. Nominal value at the rate of what? 2%. Whereas effective rate will be done on what? Initial value. Is it right? Initial value at the rate of what? 10%. Are you clear about this?
But we are doing only for 2 years, yeah?
Yes. Okay, we are doing only for 31/12. Okay, 31/12/2001, 31/12/2002. How much is the opening balance? Opening balance is 9,500. How much is the interest? 10%, 950. Okay, 10%. How much is the nominal value? Nominal value is 10,000. 10,000 at the rate of 2%. It comes to how much? 200. Are you clear about this?
Yes.
Now, what is the closing balance? Just tell 9,500 plus 950 minus 200. It comes to how much?
10250.
10250. Is that 10250? Okay. How much is there? 1025 is the interest at the rate of 10%.
1025.
This is going to be how? 200. Okay. Interest rate will not change. Is it right? How much is that final amount? Is that they are going to repay?
1075.
Is that they are going to redeem? Okay. How much is there? It comes to how much? 10.
11075.
11075. Is it right? In 11075, what is the nominal value? Nominal value is 10,000. Okay. And what is the balance is there? 1075. 1075 is the premium. Is it there with you in the question?
Yes.
That's all. Is it clear? Yes.
if it is not redeemed at the premium?
We will do in the next two questions. Is it right? Wiggins and Cavendish is there, na? What you are asking, the same thing it is there here. Is that we are doing the same thing? What you are asking, that they gave you. They know that the students will ask. Now you see the second one. Can I go to the second one?
Yes.
Wiggin raised finance. How much? 20,000. 6%. That is the nominal value. Okay? 4-year loan. January 1st. The loan was issued at discount 10% and was redeemed after 4 years at the rate of premium 1015. The effective rate of interest is 12%. What is the issue cost? Issue cost is how much?
1,000.
1,000.
Plus 20,000.
Is it
Initial
right?
recognition.
Is it right? Straight away. Don't waste time. Okay? Straight away. Net receipts. Okay? Net proceeds. Okay? Net proceeds. How much is the net? I'm not writing everything. Net proceeds. How much is the net proceeds?
20,000.
Huh? How much is the net proceeds? 20,000. Okay? 20,000. Okay? What is the discount is there?
Discount?
10%.
2,000.
Is
10%.
it 2,000? Okay? How much it comes? It comes to 18,000.
Also, yeah.
Is it right? Also, how much is the issue cost? Issue cost is
Issue cost
1,000.
1,000.
It comes to how much? 17,000. This is the initial liability. Are you clear about this?
Yes.
Simple. That's all. Nothing is there. Okay. I will tell you. My concept is very clear. Okay. Now, is it right? Now, they are talking about. Is it right? Now, what we do? You do the same process. Okay. You do the same process. Year is there. Opening balance is there. Is it right? Effective rate is there. Okay. Effective rate is there. You have the cash payment is there. Okay, cash payment is there. You have the closing balance is there. Okay, now what they say it is for 4 years. First year will be how much? 31/12, 2004. Okay, initially is how much? 17,000. What is the effective rate of interest?
12%.
12%.
Yeah, 12.
Okay, 12%. Calculate very fast.
2040.
2040. Okay, 2040. What is the coup payment? They are 6%. 6%.
1080.
1200.
No. 1080.
How 1080, dear? 20,000. 20,000 into 6% now.
Yeah, 1,200.
Okay, 1,200. It will remain same. Okay, that is the. It will remain same. Now, what is the 17? It calculate 1,700 plus 2040.
17840.
17840. Okay, this is the second year. 31/12, 2005. Okay, same process. 17840. Is it how much we'll get?
2141.
2141. Is it? This will become same. How much is the closing balance?
$18781.
Are you understanding?
Yes.
18781. 12% is how much?
2254.
2254. How much is the closing balance?
19835.
It is for 4 years. How much is the rate of interest? Effective rate?
2380.
It comes to
21015.
how much is the premium?
premium 1015.
Okay, are you clear about this?
Yes.
Third one is also same one. Okay, third one is also same one. I will do. Okay, I will do. Initially I will do, because the event is same one. There is good difference is there. Okay, there is a good difference is there. You have to talk about the Cavendish. It is a Cavendish. One time doing. Again, I am telling you, when you start a revision kit, you have to be very clear on this. Okay, they are talking about, see, they are talking about the zero coupon bonds at par. Okay, with a nominal value of how much? Nominal value is 10,000. The bonds, there is no coupon. Is that there is no coupon? There is no cash payment. The bonds will be redeemed after 2 years. 1449. Issue cost is ignored. Is the issue cost is ignored. Now, if that is the case, okay, what is the nominal value they have issued? Is your nominal value 10,000.
The nominal value will be the same.
Yes, is that nominal value will be the same. Okay, you will have the year. Okay, you have the year. You have the opening balance. Okay, you have the opening balance. You will not. You will effective rate is there. Effective rate is 7%. Okay, you don't have any cash paid. You are not paying any cash payments. Okay, you are not paying any cash payments, and you will have the closing balance. Year, 2 years only. Okay, it is for 2 years only. How much is there? 31. Okay, 31 12 2005. Opening balance is how much?
10,000.
Opening balance is how much? 10,000. Effective rate is how much?
7%, 700.
700. Okay, 700. You don't have any cash payment. Okay, you don't have cash payment. 10,700. This is for second year. 2006. Is it 10,700? What is the rate of 749? Okay, 749. How much you will get here?
11449.
11449. Is it in 11449? How much is the premium?
11449.
1449. Okay, if you take into consideration, it comes to how much? Okay. Are you clear about this?
Yes.
Okay. It means the concept is going to be very specific. Okay, what you are going to do, see what you are going to do, and how it is going to be worked it. Is it clear?
Yes.
Next. Okay, we'll work with this one. Okay, we'll see how it will work. Okay, now keep this momentum. Okay, keep this momentum very focused. If you ask me, one area where we have to be very focused is, I will say, very straightforward, financial instruments. Very straightforward. 8 marks will be there, and we have to be very, very specific. Okay, very lot of money. There is fair value through profit and loss account. There is a concept is there in this. Is it right? Out of money and in the money. Okay, out of money in the are held for trading, are measured at the fair value through profit and loss account. Yeah, what is the out of money and in the money? Is it right? Is it out of health? See, you have the financial instrument. Is it right? You are doing with the fair value. You have the value is how much you are going to say that I will purchase it for 110. If the value of the asset is 115, is it? If the value is how much? 115. You are paying 110, but you are getting a value of how much? 115. It is in the money. If at the date of purchase, the value is how much? The value is 95. you know that the value is 100, you are going to make sure that it will be 90. You will pay 100 and you will get a value of 95. You are going to pay more and get the value less than 100. You prefer that option?
No.
If you are not preferring that option, this is called as out of the money. We'll cover this in detail. I'm just giving you a small example, that's all. In derivatives, we are going to do in detail. Only thing is, remember the concept. In the money, out of the money. Out of the money means why I will pay 100 and I will get 95 value. Why I will not, I'm not interested in that. Okay, I'm not, we'll cover in detail. Is it? It is only a tip of the iceberg here. It is also possible to measure a liability at fair value when it will normally be measured at the amortized cost. Automatically, we are going to see when you are paying the loan, you will reduce. Amortized cost means what is the cost after payments. It would eliminate or reduce accounting mismatch. Is there anything is a plus or minus, it will reduce, it will show the correct value. In case of IFRS 9, that any movement in the fair value will be split into two any movement in the fair value. Is it? It will be split. How it will be split? What is the reason? The fair value change can be due to credit risk. If credit risk means if the rate of interest is increasing, rate of interest. If the rate of interest will increase, what will happen? The value will decrease. The risk that the entity will issue financial liability unable to repay or discharge it. If the rate of interest is increasing, what will happen? We cannot pay off the loans. Okay, credit risk is increasing. Is that credit risk is increasing? Rate of interest increases, which is presented in OCI. In short, keep it in mind. The fair value change due to own credit risk, which is presented in OCI. This much you can understand. Within the brackets, it is explanation. Within the bracket, it is explanation. Any fair value change due to credit risk, we have to present in where? We have to present in the OCI. The remaining fair value change will be presented in the profit and loss. We have to, any changes is there in the fair value, we have to see any changes is there. Is it any changes is there in the fair value will be split under two things. If it is anything with respect to the credit risk, you have to show it in the OCI. Okay, and the remaining, the balance, we have to show in the profit and loss account. We have to show in the profit and loss account. It's okay. Means we can understand how much is the credit risk and how much is going to be the remaining part as such. Okay?
Yes, sir.
Yeah, little bit. New things are there, very, very new things. Discuss the accounting treatment. Is that to the? On January 1st, they have issued a financial liability. How much is the issued for liability of 10 million? Interest is payable, 5% in arrears. The liability is repaid on after 3 years. McGrath trades financial liabilities in a short term. Means if it is a short term, it is through fair value. Okay? Now, at 31st December, what is the interest rate has increased? Is that interest rate has been increased? How much it has been increased? It has been increased from 5% to 10%. When it has been increased? At the end of the year. Is it? At the end of the year, the interest is increased. Okay? Is it? Now, if there is a short term, you have to use, we have to measure fair value through profit and loss account. Very conditional is there. It will not change, never. The financial liability is traded in the short term. If it is a short term, it is through profit and loss account. You asked me when I have explained you in just before now. Is it? If it is a for short term, okay, they will mention very clearly in the question. They MACDA trade financial instruments in the short term. Now, the liability should be remeasured at the reporting date, and the fair value cannot be observed from an active. Assume that the fair value of the liability cannot be observed from an active market. We have done, okay, we have done level 1, level 2 and level 3 in the fair value measurements, okay, with the fair value measurements, okay. The fair value can be calculated by discounting the future cash flows at the market rate of interest. What is the fair value we are going to do? We are going to remeasure the fair value, okay. How much we have issued? 10%, 10 million loan, okay, 5%, okay, 10 million, 5%. At the end of the day, the value has been, see, the interest we are paying at what? The interest we are paying at the rate of 5%. The discount rate, market rates has been how much? The discount rate is going to be 10%. Means whatever the payment of, if you discount it, how much is the present value? Present value is 0.45. Is it? In the second year, you have the principal. Okay, you have the principal. Principal amount is 10 million and interest is how much? Interest is 0.5. Interest is 0.5. Total comes to 10.5. You are discounting at the end of year 2. It comes to how much? It comes to 8.68. Are you clear about this?
Yes.
Slowly check, okay? Little bit. It's a more thinking one, okay? Don't rush. The interest payments are, we are paying 5 million. The fair value of the liability at the year end. Every year we have to check the fair value. We have to remeasure the fair value. Fair value is going to be how much? 9.3 million. Okay, now how much the fair value has been decreased? Okay, the fair value has been, means what happening? We are taking 10 million loan. Either loan taken is how much? Loan taken is 10 million. And how much you are going to repay? We are going to repay 0.913 million. We have taken the loan of 10 million. We are repaying by, what will happen? If the rate of interest is increases, the present value will decrease. Is it? If the rate of interest is increasing, the present value will decrease. We have taken the loan of 10 million. As per the present value, it has been decreased to how much time? What is happening? It is a gain. It is a gain. Okay, liability is decreasing. Liability is decreased by how much? Liability is decreased by 0.87. I'll put very clearly. Liability is decreased by 0.87 and the profits has increased by 0.8. Means you are paying less. It means it is a gain for you. Is it okay?
Yes, Chitta.
Okay, little bit new things. Okay, little bit new things. I'm not going to mislead you. Little bit thinking. It will take time to get it into the case. Okay, yes, we will complete this, and tomorrow we'll start compound instruments. Is there nothing is there? Is there the being regularly invested? What is the thing? How the bond should be accounted for? This is point number 1. This is point number 2. being regularly invested in assets measured at fair value through profit and loss account. If they are regularly means it is a profit and loss account means it is a short term. These assets are funded by issuing the bonds. If the bonds are not measured to fair value, if not remeasured to fair value, if you see what they are doing, and most of the people will do this, they will take the loan and they will make investments. Okay, they will make, everyone will do this. They will take the loan and they will make the investment in the stock markets. They are what he has issuing the funded by what? Funded by issuing the bond. If you are not remeasuring to fair value, there will be accounting mismatch. There will be a difference. Therefore, Bain designated that the bonds should be remeasured at fair value through profit and loss account. Why they are doing at a profit and loss account? Again, the same rule. It is for the short term. The fair value of the bonds has been what? It has been decreased to how much? 30 million during the reporting period, of which 10 million is related to what? It is related to credit risk. Is it 10 million is related to what? 10 million is related to the credit risk. And 20 million is related to what? 20 million is the remaining part. This is the remaining part. What we have done, anything related to the credit risk should be done fair value through OCI. The remaining part, it is fair value through profit and loss. Is it pay to profit? Where we have to show in the financing section. If it is it a, now what is happening? Is it a, now what, how much the liability is decreasing? Is that the liability is decreasing? Liability, how much is the fair value of the bonds has been decreased because you have taken, what is the condition? When you have taken that condition, we have the condition that we are measuring it what? We are measuring it on the basis of fair value. 30 million bonds, okay? It has been decreased by how much? 30 million. The value of the, when it has been decreased by 30 million, you are paying less. You are paying less by how much? You are paying less by 30 million. Now you are dividing that, okay? You are dividing that. With respect to the credit risk, we are saying it is going to be fair value through OCI. Whatever the remaining amount, you are going to say that it is going to be in the profit and loss account. Are you clear about this?
Yes, doctor.
That's all.